Hi, happy November, agents. I am Mariah. I am the Director of Agent Relations here at Agents Invest. And today I have Jimmy Luke. Jimmy Luke is a CPA out of Tennessee. In fact, he is our recommended CPA inside of our investor membership, and including my personal CPA. And he's here to talk to us about the strategies that we should know as both agents and investors in real estate. Welcome, Jimmy.
Well, thank you, Mariah. I'm looking forward to talking today. One of the few things I enjoy more than a great ribeye steak and a Cabernet Sauvignon is talking to folks about how we can make a lot of money and not pay any taxes. Two of my favorite things.
Wonderful. Well, why don't you tell us first how you got into real estate? Because I know that you are an investor yourself.
I am an investor. I've had I think about 275 houses and Whole Foods, built some houses, apartments. These are all with my own money. I'm a principal. I'm also a licensed real estate agent, but I only represent myself.
Okay.
So not a retail one. But how I got in is really strange. I had no intention to be in the real estate business. And my kids were in private schools, and I had about no money to pay the tuition. And I had a client of mine that was going bankrupt. He was a home builder, and he owed me about $50,000, which never, ever, ever let anybody get into you for 50 grand. But he deeded over a property to me that was worth about 100 and had about a $90,000 mortgage on it in settlement of that debt. So I woke up one day and had one little bitty townhouse, and I figured out quickly that I can do this and I can change to the trajectory of my life. I can figure out some way to pay my kids' tuition and realize that work is something I love to do now because I can see the results quickly and it allowed me to get out of the corporate rat race.
Perfect.
So it was by accident, Mariah.
You know, it's funny. I talked to a lot of people that got into it by accident. Happy accidents.
It's a happy accident. You know, sometimes the hardest things in life are where we learn the most. But let's get into talking about real estate taxation, real estate investment.
Sure. All right. Well, you know, first I want to start and I want to ask you, you know, when we're looking for a CPA that is, you know, real estate friendly, I found that a lot of CPAs will tell me that they are, you know, that they are up to date on their tax strategies in real estate, but they're really not. It's really not their specialty. What's a good question when we're calling CPAs and we're kind of vetting them? What's a really good question to know for sure if they know their stuff?
Well, I would ask two questions if it was me. The first one is, are you a real estate investor yourself? Most accountants own nothing other than their car, their house, and their accounting firm. You really get focused when you go to bed at night owing $10 million on real estate. That gets your attention. So number one, are they personally invested? It changes everything when it's your money, not just telling someone else what to do, but what to do yourself. The second thing I would ask, you know, of your client base, what percentage and how many are real estate investors? Now, most accounts will tell you that they have real estate clients. 95% of my 1,700 clients are real estate people. 95%.
Yeah.
And so, you know, that's essentially all I do. So I have my money invested personally. That's a question. The second one is, who are your clients? And you should get an affirmative answer. Just like if you go to your cardiologist and you're having a stent put in, you probably want someone who's done it more than 6 times. I want the guy who did 10 this morning. That's who I want. So just my suggestion.
All right, great. That's perfect. Well, all right. So when we're talking about real estate agents, you know, what should they keep in mind as far as tax strategies?
Okay. Well, this would apply to agents as well as investors. The first comment I'm going to make. When a new client like you, Mariah, came to me recently, you do not have a company. And the first thing you need to do is form a company. you're a real estate agent, you'll have a company as a real estate agent. You have an investor. The reason for that is not that the tax rules are different, but Mariah, do you remember why I wanted to put you in a company versus just having you be a person? Do you remember why?
Right, for tax savings.
It's tax savings because the Internal Revenue Service audits companies about 10,000 times less often than the identical individuals on their person. Anyone can Google this. This is a proprietary information. But if you accept my premise that we're going to be very aggressive on your taxation, and we're not going to lie, cheat, steal, but we're going to deduct everything, then we want to be in a position where it's very small. And sometimes less likely if the same person has a company as opposed to individual. And that company files its own tax return. That's the first thing. The second thing, which is really a little more oriented to, I guess, agents, but it could be investors as well, is we want to deduct everything remotely connected to real estate.
Right.
Now, I'm going to give some ridiculous examples. Will that be okay, Mariah, to mention?
Sure. Yeah, let's hear it.
All right, so I just got back 2 days ago. I took off 2 weeks after a busy tax season ended October 17th. I went to Tampa Bay, where my daughter, who's a physician, and her family there, to visit them. And then I flew to Atlanta to visit my son and his family there. Now, so I'm flying, staying in hotels, eating well, because one of the things I found is even though my children do quite well financially, I always buy dinner. I have never figured that out. Something happens.
Really bad. Yeah.
Well, it's supposed to be that way. But my daughter is building a Big Mac mansion across the cove from Tom Brady, which that's a whole story. And I've done this before. I've run multi-million-dollar projects. And of course, I'm flying to Tampa, Mariah, to be a consultant for their financial and tax strategies for this property. And while I was there, I negotiated dockage because they're on open water behind their house, so that when I go to Florida in a couple of weeks on my boat, I worked out a financial arrangement to rent their dock for my business boat.
Okay.
Tampa is fully deductible. Then I go to Atlanta, where I have a business arrangement with my son and his 3 sons to develop some property. So I'm there to play with my 12, 9, and 7-year-old grandchildren who are also partners in this business development.
Right.
It's a business trip.
Yes.
A few weeks before that, I absolutely had to go to Paris, as in France, to look for real estate with my lady friend. She's a real estate investor as well. And so don't you know, Mariah, that when I checked out of that hotel, I said, well, is this business? And the answer would be, what would it be, Mariah?
Of course it is.
Of course it is. Of course it is. So those are a couple of what many people would consider ridiculous examples. And I've got 100 more. But what we're wanting to try to do is take what we're going to spend money on anyway and create a business reason for this. So like when I was in Paris, I made it a point. I looked at probably 10 properties while I was there. I have invested overseas before. That I met with the agent. I gave them my email. As soon as I give them any of you agents out there who know this, get someone's email address, you're going to fill it quickly.
Of course.
Now I have established I was there looking for property. Sounds like a business trip, don't you think, Mariah?
Absolutely.
So, Mariah, I was commenting on your wallpaper behind your head right now. It's lovely wallpaper, don't you think?
It is. I used my new business credit card to purchase because it is for my office.
So, Mariah, how do you make wallpaper? How do you do that? What's the
How do you what?
How can you reach a I agree with you, by the way. So,
Mhm.
so why is it actually?
Well, because it is part of my office and I am utilizing it for Facebook Lives and interviews and things like this. And it is.
Absolutely. You are absolutely sitting at my feet right now. And I'm going to try to get my camera over here. Well, it's not showing well. Labrador Retriever. He is 11 months old. He weighs 100 pounds. $10,000 for deductible, Mariah?
Well, I know he is. Let's tell us why. This is funny.
Well, I'm an investor, and when I go in, let's just say, sketchy neighborhood, he is always with me. Now, I'm business attire, jacket and tie, and I've got a nice sedan I drive in. But when I go look at property, I am always in my 6-year-old dented F-150 pickup truck, and my dog rides in the bed of the truck. And when we pull up to a house, it might be a burned out druggy house or something, then I am going to ask him to bark. And since he's a pretty intelligent dog, he ought to be for $10,000. He's going to start barking. All the bad guys run for cover. It might have something to do with a very large Glock sitting on my time. And Mr. Glock is deductible as well, Mariah. Would you disagree with those?
Well, no, I think it's all deducted.
Okay. And I might mention to any of you who are listening now, if you want to send a question, you can send it live right now to my email, and I'll try to answer it during this presentation. It would be Jimmy, Jimmy, at Titan, Titan CPA.com. Jimmy at TitanCPA.com. If you'll send that to me, I will do my best to answer that question while you're here.
All right.
So now we've deducted trips, dogs, guns. Anything else you can think of, Mariah? What do you think? How about Mariah? You know, like this is a modern era, and someone's on a date, and whether it's a male or female, and somebody's paying for that dinner. You agree?
Agreed. Yes.
And those of us in real estate, we talk real estate all the time. In fact, that's the reason we have very few friends, is because we talk about real estate all the time. So therefore, these dates are really business bills. Now, I'm also someone, it's cool in Tennessee now. And so Friday night, it's going to be probably about 40 degrees, 50 degrees, perfect weather for a fire. And so I'm having about 15 guys over, and so if anybody wants to engender favor with me, send me a bottle of scotch. It gets my attention very quickly. And so I'm going to sit out there. And since I just got back from Florida, and I was able to find some actually real, authentic Cuban cigars, so we'll sit around in front of a bonfire and eat incredibly cholesterol-filled fatty steaks, smoking incredible cigars, and drinking large quantities of scotch. Does that sound like a business meeting, Mariah?
Absolutely.
Absolutely it is, because there truly are. Probably half the people here will be my clients. The other half will be attorneys, real estate agents, builders, investors. Because as we said, I have very few friends because all I do is talk about real estate. And so my real estate guys will be here.
So your friends are your clients.
Always, always. And Mariah, do you know what's happening next Tuesday in the United States?
No.
It is election day.
Oh, yes. Yes.
So whichever of the political spectrum someone's on,
right,
then they really should have a party next Tuesday night and watch the election results come in. Does that sound like a real estate event, Mariah?
Well, I'm sure you could make it into one.
Well, do you think taxation is important in the political process? We should know this.
Yes.
Absolutely. So, do you think my guest will be talking about this?
Oh, yes, absolutely.
Absolutely. And so, even an election night event
Mhm.
is a business event.
All right.
Strange stuff. Mariah, what is the one question do you think people would like to ask? Because they getting a free ask right now. What would you think you would want to know? When I met you a few months ago, Mariah,
Right. Mhm.
and you had lots of questions.
I did. I did. Right. So, well, why don't we talk about one of the biggest things as far as investing goes, which is that when should we use accelerated depreciation and cost segregation? Because that is actually something that I'm pretty new to, even though
Absolutely.
I. Mhm.
Well, let's first get a premise of what these words mean.
Okay.
The first thing is bonus depreciation is simply a methodology that allows you to expedite or speed up writing off the cost of your property. It is combined with cost segregation. The two are really bound together. These are tax words. So let me give you an illustration, Brian. You go and buy yourself a $100,000 blue collar residential unit, a house. Okay. And I'm using 100, even though that would be hard to find at that price, just to make the math easy.
Okay.
When you buy this house, you think you're buying a house, but what you're doing is you're really buying components of a house.
Mhm.
You're buying bricks, mortar, 2x4s, you're buying land, you're buying toilets,
Mhm.
you're buying air conditioners, you're buying hot water heaters, you're buying doors. All of these items, except the land and the 2x4s, are personal property. Personal property is different than real property. Real property is what's attached to the land. Personal property is usually what we think of as equipment. Think of a forklift as equipment.
Okay.
But all of these various components of your house are really personal property because they can be removed and the house still stands. So there are different studies called a cost segregation study
Mhm.
that have established what percentage of a typical blue collar house is equipment. And it's usually about a third. This would vary if you're in places like California, where the land is much more valuable, or a location like Maui.
Okay.
Excluding those, if you're in middle America, you're in Nebraska or Tennessee or Missouri or Pennsylvania, typical blue collar communities. So you go buy your property, and I'm going to give a ridiculous example, but it's a true one. On December 31st, 2022, at 9 p.m., 3 minutes before midnight, and you go and buy yourself a $100,000 property, we're going to be writing off approximately $35,000
Okay.
that moment, even though you owned it for 2 hours. And let's just say you got 100% financing. That doesn't matter. We're taking a $35,000 bonus accelerated depreciation deduction day one, which is astounding to me. Yesterday, I was on the phone with some really good clients of mine in the Columbus, Ohio area. And these are two partners, and they have about 200 houses. Last year, each of them made approximately $750,000. But on their tax return, because they have about 100 or so properties, they lost over $1 million. So I was on the phone explaining to their bank, because the bank had rejected their loan because they saw their tax that they'd lost $1 million, and they turned them down the loan.
Right.
So I walked through the tax return so that they could see that the $1 million loss was strictly because of depreciation, which is then added back to your income for loan purposes. And my guys really made $750 a piece. They got the loan. And
Wow.
I hear there's a 20-year-old bottle of Macallan that will be delivered to my office tomorrow. So that's the thumbnail of it. If you're a real estate investor, bonus depreciation is your friend. You would always take it, even if you get it like to my clients yesterday. It put them into a loss situation. That loss they cannot use this year because they've already zeroed out income. Will be
Okay.
carried forward indefinitely to the future.
Wow.
Always a good idea.
All right. What do you say about the 1031s?
1031s are the equivalent of eating fettuccine Alfredo with no carbs and no garlic breath and no fat at all. It's like there's nothing bad about this. And fettuccine Alfredo just happens with heavy garlic and heavy butter with shrimp.
Mm-hmm.
And I am just, the cholesterol is coming out my pores after I eat this for 3 days. But, you know, I don't get to eat this very much anymore. And when I'll be serving these ribeye steaks with my buddies, I will probably have chicken because it's better for me. But Section 1031 is a code section, Internal Revenue Code section, that allows me to sell a property and then buy another property of at least the sales price of the original property within 180 days, and I pay no tax. So let's go back to our illustration of this $100,000 property we bought, Mariah.
Okay.
So we buy this $100,000 property, we put a little money into it to fix it up, and now we make it worth $150,000. So let's just say I have $110,000 into it, and I get a great offer for $150,000. I would probably sell it. So I would sell the property. I have a $40,000 capital gain on this property. So depending on my tax rate, I'll owe somewhere between $10,000 and $20,000 on that sale. But if I do a couple of things, number one, I've sold it for, what did I say, $150,000. If I sell it for $150,000, I've got to buy another property or properties. I can combine properties of at least $150,000.
Okay.
Within 180 days. I can't walk away closing with money in my pocket. It has to go to a third-party escrow agent, which is easy to do, and buy another property. So the goal that we have in real estate investing is to always buy cash flow properties that produce income day one. Secondly, we always take accelerated depreciation so that we can not pay tax, any tax, on our cash flow income. And then thirdly, when we sell a property, we're going to buy another property in a 1031 exchange and just move up the food chain to nicer houses. And then, Mariah, the very last step in this perfect tax planning is to die. It's actually great tax planning, Mariah, because if you die and you then leave this to your spouse or your children, nobody ever pays tax at all.
Okay.
And they get what's called a step up in basis to whatever market value is tax free. Oh. They get to start all over again. It's a virtuous cycle. Virtuous. Most people don't like to die, but if you're going to die, you might as well not pay taxes.
Die tax free.
Tax free. Die tax free is a wonderful thing.
Perfect.
But But the key thing is to, in my opinion, because I deal with, like I said, I've got about 1,700 clients, and the clients I see that are successful long term, as opposed to get lucky on one or two deals, are those that day one when they buy a property, that property cash flows. Because if real estate starts to decline, which it's starting to slightly now, it doesn't matter to me. I'm making on a $1,200 rental, I'm making $400 a month. Yeah. I don't care. I can own that property for forever and make cash flow. And because of accelerated depreciation, I pay zero income tax. Zero income tax on my rentals. Cash flow rentals, no income tax. It's kind of getting back to that fettuccine Alfredo again, with the butter and the garlic and cholesterol and all that crap. To eat it, and I stay a size 29 waist. It's a wonderful thing.
Perfect. I love it. I love your analogies. All right. So let's see. Is there any last tips that you would like to tell our audience?
Well, the first thing we'll repeat it is you really must have an If you're just doing this in your own name, you are accelerating your risk of being audited by the IRS. And we've all read where the Internal Revenue Service is hiring, what, 30,000 auditors or something like that. And you must have an entity to reduce your chances of being audited. Bank account, we will have a credit card in this, and you'll pay all of your expenses through it. Keep yourself organized. Lastly, properties. They cash flow day one. If you're rich and get lucky and sell it and make a gazillion, that's great. But if you're wrong, you will never go broke owning cash flow properties. And
now we talk a little bit of cash flow, like investing long-term versus flipping.
Absolutely. You know, you can make money flipping, but if you've got a cash flow property, you can always sell that property. But if you're buying a property simply because you think you can sell it to another fool at a higher price than yours, that's a recipe for disaster.
All right. You heard it here. Well, for all of our audience members, what is the best way for them to find you?
The best way is by email. It is Jimmy, Jimmy, at Titan, Titan CPA.com. Jimmy at TitanCPA.com. My assistant is Doris, the same nomenclature, Doris at TitanCPA.com. And we'll work out a video meeting, a phone call, or if you happen to be in Paris the first week of January, I'll see you there and I'll buy you lunch because I'll be going back
for a business trip. So, business,
absolutely. You know, the fact that my girlfriend, oh, excuse me, she's not my girlfriend. She is my client and fellow real estate investor. It's a wonderful thing. So, but I'd love to work with you. This is what I do, all I do. And I love getting to know you. And we'll talk about other things that we can deduct, like a boat. A boat is a wonderful thing. We'll talk about that again. But boats are, of course, real estate necessities. Do you not agree, Mariah?
Depends on where you live, I guess.
Well, if you're going to look at property on the shore, you have to have a boat to look at it. Would you agree, Mariah?
Absolutely.
Absolutely. So anyway, we'll have lots of fun, and hope you'll give me a call.
We'll deduct boats and dogs.
Dogs, duck hunting. I'm in a duck hunting country.
Oh, wow.
You know, I would say drugs, but that would be inappropriate. Let's just say McAllen. There we go, McAllen. And cigars, and ribeye, and fettuccine, and Paris.
A lot of fettuccine. All right. Well, I will put all of Jimmy's info in the comments as well so that everyone can find you. Thank you so much for coming on and being my guest today, Jimmy Luke.
I had a great time. And Mariah, make sure you deduct all those meals now because you need to do better. We do not want you to pay taxes next year, Mariah.
Thank you very much. All right. Thank you for watching. Bye, everyone.